As somebody who helps early retirees retire with confidence and have a tax efficient and sustainable financial plan, I'm a huge fan of tax gain harvesting. And you're probably watching this because you want to know more about it. Now, there are many videos out there, and a lot of them are not factually wrong, but they're not practically helpful, and I'll explain why. So many of these videos are going to tell you how to pay zero tax on $100,000. The problem is they're just going to walk through for you how you would take capital gains, and in 2026, if you're a married couple filing jointly, as long as your taxable income is below $98,900, you will pay $0 on those taxable gain distributions. Now that would be you take long-term gains from a brokerage account. Now here's the problem. It's not sustainable for many of us. So the problem is most retirees, a bulk of their retirement assets come from employer plans. Those are things like 401ks, rollover IRAs. And then when you get to the brokerage assets, there's just not as many people that have brokerage account assets in the multi-millions. So if you were to sustain withdrawals of $98,000 on an account like that, you would literally drain the account within a set number of years. Now, what if you're an early retiree? What if you want to retire at 60, 62, 63, one of these numbers, and you want to delay Social Security, at least for one spouse? What I'm going to show you is how you can interact with tax gain harvesting, potential early Social Security withdrawal, so you don't have to necessarily delay all that gratification, and also maybe layer in maybe some hobby income, because to me, this is much more of a realistic scenario. So if you're someone who wants to know, how can I pay zero tax and live the way I want to, this is the video for you. And also, this is going to incorporate the benefits of a health savings account as well, because when you take money out, what you live on is not the same as what you pay tax on. And I'm going to show you that clearly in this video. So without further ado, I will continue on to the video. Now, by way of disclosure, this is not personal financial tax or investment advice. It's just for education. I love doing these videos, but it is absolutely not applicable in every case. So hope you learned something. My name is Forrest Dutton. I am the owner of Brightworks Financial Planning. I'm a certified financial planner. I love to help people retire with confidence. So now, on to the rest. Okay, let's discuss. We have today a 62-year-old couple. They're both 62, and they are just ready to retire. They do not want to work. Both couples are just fed up with work, and what matters to them more is quality time. And one spouse particularly wants to do something that they love. They want to work at the library, and they just want to do it not because of money. So here's why I'm calling this the realistic way to pay no taxes on $100,000, because it's not going to be just as simple as take out $98,000 of capital gains. For most people, that's just not realistic. So let's go through the numbers. So what we have here is, again, like I said, age 62, we have income. Okay, so as our income, and I'm going to show you this line by line. So what we have is wages, $15,000. That's the passion project. That's working part-time at the library. One spouse retires, wants to work. The other one doesn't really know what they want to do yet, so they're actually not having any income. The spouse that is working is the one that's drawing Social Security. Since it's under the wage base for penalty on Social Security for an early withdrawal, no harm, no foul. So we have $15,000 on income. We also have $24,000 in total Social Security benefits. Again, one spouse only. That's not both spouses. So a better way to say that would be $2,000 a month. So that's our income. And there's another way that we're going to withdraw income, and that's going to be we're going to take long-term capital gains. Okay? And again, this is probably what you've seen. So just to remind you, in 2026, if your federal taxable income is $98,900 or less, you will pay 0% on long-term capital gain withdrawals. So how do we get there? So we've already mentioned our income, but we're not going to portray someone who has $3, $4, $5 million in a brokerage account, because it's just not realistic for many of us. So this person has been a diligent saver, and they have $1.25 million. So again, a great saver, a high earner, somebody that was really good at saving in a brokerage account. And they're going to take out 4.5% of that, again, just to demonstrate, and that's going to be $56,250. Now you're probably going, Forrest, wait, I see $22,500 on the left. How does this work? Well, I'm about to show you. And the short answer is 25% of 56,250 comes back in the form of gains, because what you're seeing on the left is basically a rundown of how this will be reported on a tax return. So that's how we get 22.5. The rest is a return of their own money. Okay, so hopefully you're following me. So let's track down what we're actually working with. Okay, so if we're adding this up, we're living on a combination of 24K from Social Security. Sorry, that was wrong. 24K social, 15K wages, and 56,250 from distribution from the brokerage account. Now, if you do this math here, you'll go, wait a second, Forrest, I thought this video was how to pay no tax on 100,000. This is only 95,250. And the reason I did that, and I'm going to show you, is remember, what you actually need and pull out for tax is not always what you live on. So this person, in terms of assets, in addition to their brokerage account, also has an HSA. And they have 50,000. Okay, so where's that extra roughly 5,000 going to come from? Well, the answer is you retired. You have to pay health care somehow. So I want to draw your attention to one piece of this puzzle. So of this 95,250, we're going to have to add something for health care. Now, if it's withdrawn from an HSA, and again, that's a qualified distribution, that's not going to show up on this column. So therefore, that's how we're going to get to the 100,000, is because some of that's got to pay health care. But I want you to see how they pay that health care. So what you're going to have to do is you're going to have to add up all these income sources. So if you look on the left, you'll see 15,000 is wages. Obviously, that makes sense to most of us. That's regular, ordinary income. But some of this Social Security on the left is not taxable. That's just how Social Security works in terms of your other income. It's called provisional income. I'm not going to go through it in this video, but that's how that is not all taxable. However, when it comes to early retiree health care and the Affordable Care Act premiums, you have to add in all sources, even non-taxable for Social Security. So even though this line is going to say that their total income is 48,175, that is not true in terms of how their income is calculated for healthcare. So I'm going to show you over here. This is the number of that income for healthcare. It's 61,500. Now this is a U.S. average. It's a calculator. And what this is saying is, in this case, this couple has a couple health issues, so they do not want the bronze plan. That would be the highest deductible, the riskiest in terms of how much they could pay out of pocket. They chose the $496 per month plan. Okay, so what is 496? Annualized answer, $5,925. So, sorry, $952. So because of that, this is their healthcare costs. That's how we get to, it's actually roughly 101K. Now remember, you're going, wait, this is supposed to be about no tax. Show me the no tax. Okay, I will. So let's go here. We have the adjusted gross income. We have a standard deduction of $32,200. The taxable income is $15,000, which again is lower than our standard deduction, which is why our total tax is zero. So this is the realistic way to spend no money on taxes when you withdraw or live off of roughly $101,000. Now, why is that important? It's super important because realize this brokerage account is what allowed them to bridge the gap. Now, again, unlike other videos, this is not just saying, hey, draw $98,000 out of a brokerage. That thing might be gone in less than a decade, and you may not want that. So if someone has a goal for doing more realistic tax planning throughout retirement, in this case, we have a couple that's age 62. they might want to try and do some tax planning between 62 all the way to 70, because if the other spouse wants to wait till 70 to draw Social Security, then they have some window to work with. So again, I want to make this video short, sweet. Hope it was helpful. Just wanted to show you the realistic way to pay zero in tax. Please subscribe. I would love your comments. I want to know what you think about this. To me, this is a practical and actionable way to make use of the different ways that income is taxed in retirement so that you can retire with confidence, and in this case, maybe even early, and maybe early the way you want to. So again, taxes are a part of this, but I want you to hear loud and clear. The reason I made this example is because this couple said, you know what? I know I could wait till 70. I know we both should wait till 70 to do Social Security, but in our case, we don't want to. Life is short. I want to work at the library. I want to go for a walk and just enjoy my life. Retirement is much more than math, and your goals are much more than taxes. So remember that, and I will see you guys on the next video.